Treasurer, I don't think
One.
all those sides.
All right, we are live.
We may have
Elected officials.
Susan, can you hear me?
Yes, I can. Thank you.
We're live now.
Yeah.
Okay.
But it's up to your pleasures.
Go over.
You can speak order whatever you choose.
You ready? Okay, let's 10:04. Let's call this meeting to order. Just make a note, Michelle is on her way here. She'll be here shortly, but Teresa, will you take roll call? Unintended consequence.
Okay, Gordon,
Here.
John,
Here.
Dr. Pandolfi,
Here.
Michelle, and Ron.
Here. Okay, the agenda is in front of you. A couple things. You have minutes. Unfortunately, I had a little trouble finding them. If everybody else has read them, we can go through those. The item number 9, the wording on that should be changed to levy calculation and rate recommendation. And number 11 is not a voting item. I think those are the only changes I have. Is that right, Susan? We talked about it.
Quickly do introductions since
Oh, sure. I'm sorry.
we have our new board attorney here, Mr. Bill Moore is here. If you just want to introduce yourself real quick, we'll do this again at the full board meeting on the 20th. So some of you are going to hear this twice, but
Sure.
then did you get all the way around to introduce, or do you want? Go around.
I stopped with the chairman.
Okay,
So my name is Bill Moore. I'm an attorney with Rouse Fred White Goss Gentile Rhodes Law Firm. I've been practicing with them for several years. Prior to that, I was with the White Goss Law Firm that merged with Rouse Fred's. Prior to that, I've had other experiences, including a stint as city attorney for the City of Independence for the actual city attorney for a little bit over 15 years and represented the city in other capacities for another 5 or 6. I'm very pleased to be here, honored that I was selected to be your board attorney, and I'm looking forward to working with you all. Welcome. Welcome. Thanks.
since you met John, me, Ron, Gordon. Brian, do you want to introduce yourself?
I'm Brian Gash. I'm the Chief Technology Officer for the library.
And I'll quick follow. We met yesterday.
Yes.
Teresa Johnson, I'm the board secretary, and I sent you an email.
Thank you.
How you welcome.
You know Jim, and then Michael, if you want to introduce yourself.
Michael Kinnan, I'm with Hood and Associates, here to present the draft results of the financial audit for the year ended 6/30/2022.
Yummy, do you want to introduce yourself real quick, please?
Yeah, it's sort of hard online, but Yummy Pandolfi here. And hopefully in person one day we can have a better introduction. Yeah.
Thank you. Thank you.
Okay, so I will need a motion to accept the changes to the agenda.
Were there changes to the agenda? I'm sorry.
Yeah, I am changing the title of 9.1 to levy calculation and rate recommendation. And on number 11, I am removing the voting requirement.
Well, could you explain the significance of that change?
Which one?
The change in the levy issue.
The wording there was just communication error between Susan and Teresa. It was discussed as to be a calculation, not an acceptance of the ceiling, whatever the ceiling rate is defined as. So we have that, and we have the subsequent item number 10, which is to address the budget subject to the levy rate recommendations. So that brings it in sync with number 10.1.
Thank you.
Motion?
Still moved.
Second? Did I miss it?
Who was first?
Did you?
I don't
make
think
or
it matters.
Yeah, me.
Hey, we got you either way.
Okay, all in favor, say aye.
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 And abstain. Okay, so that passes. Okay, Michael, you're up with the 2022 audit report, financial report presentation, related letters.
Good morning, everyone. Again, my name is Michael Keenan. I'm with Hood and Associates here to present a draft of the financial statements, the annual comprehensive financial report for the year ended June 30, 2022, the larger document that was in your packet, as well as a smaller document, which is required communications and management. Also, I have provided Juan did you get my PowerPoint?
Yep.
Okay. To help go through and highlight the results. Again, on page 1, Hood and Associates.
You're over there. This is my screen, which I'm just going to take down.
Okay, I just want to make sure that we're, again, a little bit about Hood and Associates. We've been serving Missouri, Kansas, Oklahoma, and Texas. Again, you may recall last year, our firm was called Cochran Head Vick and Company. And during the year, we were acquired by Hood and Associates. They're primarily located out of Tulsa, Oklahoma. And they acquired all of Cochran Head Vick and maintained all of the offices and all the personnel. So it's kind of, other than the name change, a lot of it, the day-to-day activities have stayed the same. We go through what's called a peer review. And again, we have been awarded the highest rating as a result of that review. And we're members of the American Institute of Certified Public Accountants, the AICPA Government Audit Quality Center, and one member, which happens to be me, is the Audit Review Specialist for the Government Finance Officers Special Review Committee. And that's where I receive reports from other municipalities on the annual comprehensive report that participate in the excellence in achievement in financial reporting. I review those reports and grade those and give those back to the GFOA and determine if they pass or fail. And we're licensed to practice, again, in Missouri, Kansas, Texas, and Oklahoma. Page 2, the scope of the audit. Again, we were engaged in a formal audit of the financial statements of the Consolidated Library District, 3, also known as Mid-Continent Public Library, for the year ended June 30, 2022. And as I just mentioned, the Mid-Continent Public Library presents this report to the Government Finance Officers Association for participation in the excellence in financial reporting. And they first started doing that in 2011. So this would be 10 consecutive years. And we believe this report for 2022 will also qualify. So that would be 11 consecutive years. And that's a great feat. Next, our responsibilities as the auditors is to conduct our audit in accordance with generally accepted auditing standards, as well as governmental auditing standards. We're also responsible to plan and perform our audit to obtain reasonable but not absolute assurance that the basic financial statements are free of material misstatements. We're also responsible to report on the entity's internal controls as well as compliance with finance-related laws and regulations. The Auditing Standards Board of the American Institute of Certified Public Accountants, the AICPA, which dictate what we do as far as our auditing, recommend that we communicate these matters to the governing board. Illegal acts, again, none came to our attention as a result of us performing our audit procedures. Changes in significant accounting policies. There were no significant changes in accounting policies for the year ending June 30, 2022. Pleased to report that no difficulties or disagreements with management, and we were provided full cooperation and access to all the books and records and transactions that we selected for testing. Page 5, financial and compliant audit really addresses these three basic questions. The first question, are the financial statements free of material misstatement? Our response to that is we have issued with this unmodified draft, since this is in draft form, that indeed the financial statements of the library are fairly presented in all material respects. Question 2, are internal controls over financial reporting adequately designed and operating effectively? Our response to that question is we did not identify any deficiencies in internal controls or financial reporting that we consider to be a material weakness. Again, had we done so, we are required by our profession to report those to the governing body. Finally, did the library comply in all material respects with finance-related laws and regulations? The results of our testing disclose no instances of non-compliance or other matters that are required to be reported by our profession. And the smaller document is a required communication and management letters, kind of outlines what I've already talked about and some of our requirements. With the future accounting pronouncements is they've issued 2 more in the month of June. So now we're up to 101. And they seem to be adding those 1 or 2 a year. And we list those all in the required communications. And as we've talked about previously, the most significant one that will impact the library coming up next year will be the leases. So what the change in that is, if you have what's called operating leases now, those will change to right to use leases or similar accounting to as a capital lease. So those will come on as a intangible asset, right to use asset that you'll amortize over the life of that lease. And then there'll be a lease liability. So they're kind of going away and following the private sector and requiring all leases, whether they're operating or capital, to be reported. And then I was followed up on the prior year comments. We had a comment regarding there was a violation on budgeting. Again, in the current year, we did not note that any funds exceeded the budget appropriations. And we had a recommendation related to cybersecurity. And then we just continue to recommend that that be on the forefront. Again, it doesn't go by many days that you don't hear about somebody being attacked or violated. And they're really going down lower and picking on lower level governments and that have less stringent controls there. And then future accounting pronouncements. And the library adopted all accounting pronouncements that were required to in 22 that had an impact. A little bit on financial results, just to highlight. Again, looking at the government-wide financial statements, which include all of your capital assets and your liabilities, net pension asset, and related amounts. And looking at that, the net position of the library totals $149.7 million. This was an increase of $8 million from the prior year. Again, looking at your chart here, a majority of your net position and is due to your capital assets related to that. Then you have some restricted funds, and then you see the portion that's called unrestricted and is available for use. And on page 8 to continue, again, at the government-wide, I kind of already mentioned this. The most significant obligation that the library has at this point is the 2018 certificates of participation. The balance at the end of June 30, 2022 was $58.7 million. Also, the more significant components, the library reported a net pension asset of $19 million this year, compared to a net pension liability of $3.6 million, or $23 million change. Really significant change, but to correspond and kind of offset that with the pension, there's also deferred inflows and deferred outflows. And the reason that net pension asset went from a liability to asset is the investment earnings in the plan were like 28 million, a really large number. And obviously, I think that was going to switch around next year. So it may go back to a net pension liability. However, what they do when they have this big change in investment earnings is they will allocate that over a 5-year period. And that's why your deferred inflows, which offsets that deferred asset, those totaled a change of 19 million. So that kind of offsets the net change. There is something to, again, monitor. It's not an asset the library could use. As you know, the loggers does an annual valuation and determines your contribution requirements. So that's really the annual cash outflow that the library has to consider, and you do budget that every year. As far as the general fund revenues, they exceeded expenditures before transfers out of a little more than 6.6 million. There was a transfer out to a capital project fund of 1 million. The general fund balance increased from the prior year, 5.2 million, resulting in ending fund balance at 6/30/22 of 35.2 million. Of that amount, 32.6 million of that is unassigned and available to be used. Again, looking at the unassigned fund balance is approximately 57% of your 22-23 general fund expenditure budget, which is a little over your stated general fund balance policy of between 20 and 50%. And historically, if it exceeds the 50%, funds have been transferred or used for legal purposes, transferred to the capital projects fund to help fund future projects. And I just noticed I'm still referring to Cochran Head Vic. So.
Okay.
So, as you know, you start with the last year's and you roll it forward, and some things there was like you're looking for the crux of it. So, okay. But Cochran Head Vic, as well as Hood and Associates, certainly appreciate the opportunity to serve as the auditors for Mid-Public Penton Library. And also we do this audit and associates, Ralph C. Johnson. Ralph couldn't be here this morning. Ralph has been associated with our firm doing this audit since many years since we've been doing it. So I want to especially thank Susan and Juan, as well as the other library staff that assisted us in this engagement. Very professional and do a great job. And it's a pleasure to work with clients where we can come in and audit versus helping do other bookkeeping and making adjustments and auditing. So thank you to both, as well as the members of the staff. That concludes my presentation. Are there any questions that I might be able to respond to?
Michael, I was just thinking, so the accounting for leases, is that kind of like the old FASB 13 approach.
Yeah. It just kind of takes that out so that every lease
Sure.
qualifies as either, it's still a capital lease.
It's capital.
I mean, that still qualifies and you report that as a obligation, but you also now report right to use liability.
Yes, we're kind of doing what everybody else had to do for 40 years.
Yeah, so I think the one that the Red Ridge is a long lease agreement for rental. So that next year we're reported as a right to use asset at conversion and a right to use liability. So then those lease payments are treated just like a capital lease. A portion will reduce the liability, a portion will be interest, and on the other side, you'll be amortizing that right to use asset similar to depreciation.
So are those two always in sync?
Not necessarily. They'll end up in sync, depending on how long the useful life is of the asset. I think that so there could be various, but at the end, when the lease is paid off, then the should zero out.
So
So
what's the term of that lease, remaining term?
25. That was 25 years.
It is 25 years.
we'll, at conversion date, at 7/1, we'll calculate that amount and book it. So, and then any other leases that you may have. Copier leases, again, we just have to look at those.
Is there a
And this,
materiality limit on those to where that comes into play?
there is. Yeah, I think looking at it, if it's, if you only have, an organization has just one or two copier leases, that's not material to their whole, it doesn't make sense to implement a GASB. And they specifically say within the literature that this only applies to material amounts. So it's going to be, for some organizations, it's going to be extremely burdensome. I think here there's not very many. So it's still going to be a change that's coming. And they've had this out there. They extended it for a couple more years after COVID. But this is GASB 87, and now we're at 101. So that kind of gives you a timeline. But that's I think will be the biggest change affecting the library's financial statements for next fiscal year.
Any other questions, John?
Michael, in the past, we have we've added additional funds to the state pension system. Is it possible that we'll be asked to do that again in the coming year?
That I don't believe they'll ask you to do that. I think organizations can volunteer to do that. I do know that there's when they do the actual evaluation, they can't increase your rate by more than 1% a year. But I don't think there's a requirement that they're going to say you need to contribute on your deficit, especially you're showing at this point in that pension asset. But again, that could change. So I think you would look at that as they give you that annual valuation and chat with those folks to see would it be advantageous to do something that may lower your rate for future years.
One other question, was there any discussion about early prepayment of the debt that we have? Was there any discussion of that in the process of the audit?
There was not a discussion of that. Certainly, I think you would evaluate. I don't know what the call dates off the top of my head are. But your advisor could look at that to say, is it advantageous to advance refund those cops to say, would you save some money and the debt service? And then there's a present value calculation that is the true savings. Certainly that would be something to explore to see if that would benefit the library as far as the outstanding debt, and we save any money on future debt service payments.
What is that date, Quan?
I believe it's in 2026.
So that would be the first time that we could have an
That's-
option of,
I think that's the only time.
so that's something that we look at in the future.
Yeah, I would think your bond counsel and advisors would certainly look into that for you as that date comes up and come forward and say, here's some potential opportunities if, again, they exist, depending on the interest rates at that time. You know, a lot of other factors that not really sure at this point, but certainly something to keep on radar to look at to see, is there a benefit to refund or pay some of those, pay off early if you can do that?
Michael, at some point in time, I think mostly publicly, our chairman has said that this is not a real audit. Is this a real audit?
Well, I think it's a real audit. We follow our professional standards and do our testing and do our reporting in accordance with our standards. So I believe we do our procedures sufficient enough to present an opinion on the library's financial statements. So I'm not sure what a real audit, what that means.
You want to quote a date on that?
No, there were several times in public sessions that you mentioned that this is not a real audit.
I don't think I've ever said anything of that nature. I'll be glad to go back and look at the tapes. I think what I said is that an audit is designed to express an opinion on the financial statements taken as a whole. It is not intended to detect fraud. It is not intended to be an oversight function of the accounting process or the disbursement process. Those are different aspects. Okay. I don't believe, John, I've ever used the term real audit. Okay. But if you want to find the tape and the date, I'll be glad to.
Sure, I'll be glad to look for it and remind you of it.
Okay.
You do a lot of audits, I assume, Michael, in the course of a year. How many audits does your firm do?
I would say 40, 50 of different types of audits. Primarily the ones I do are governmental audits, but we have others that do not-for-profit and then for-profit audits, as well as some pension plan audits.
So when you stack this audit and the results of it up against all the other audits that you do, where would you place it in terms of quality of the audit findings?
Well, I hesitate to grade, so I'm not going to say that. I think when you look at the report, when I say that, and we have to report any material entries that we find have to be reported in our management letter. And we didn't have any material entries, nor did we have any entries to the trial balance. And so that compared to other entities is very high. That doesn't happen very often. And if we find any errors, that we will present those to management as form of journal entries. Certainly if they're material, we're going to require that they post them, because if they don't, then I'll just change my report. They still have the option of not reporting that. Also, if there are errors that are not material to the financial statements, then we are required to include those in a management representation letter so that those will be known. So I think when I'm just evaluating, looking at the results, very positive that we don't have to make any journal entries to report the financial statements are materially correct. And I can't say that on others. And for those that we do make a bunch of material entries, then we require to report a material weakness. And then we report that to the governing body, that we had these issues and that they need to, again, make some recommendations on how they need to address that. And some entities just don't have the personnel, the quality of personnel to do that. So hopefully that responds to your question.
Yeah, that's right. Okay, thank you. Thank you for that. One other thing. In the past audits, I know you have been asked to kind of present a little surprise in the audit in terms of asking for some information in detail that would be surprising to the administration. And that's not because anybody mistrusts the administration. It's just because it's good practice to test that by surprising the people in the audit. Did you do that this year?
Yeah, we did.
And what was that?
What we did is we lowered the scope of some of our selections from, again, we use a standard scope generally of an amount. We've been through the audit process. And so as a surprise, we lowered that. If somebody that's experienced in knowing what our scopes are, if they were doing something, they could do something that they know we wouldn't test. So that's what we do. In this particular instance, we lowered the scopes.
Okay, thank you. That's my question.
Michael, put in another word, isn't what you call these surprises, isn't that basically an element of general accepted auditing standards?
Yeah, there's a requirement that we perform some unexpected tests. It could be some area that we haven't tested before, or something if there's an area that the management expressed concern
Yeah,
about.
so it may be a surprise to the client, but not necessarily anything novel to what we've been doing forever as an auditor.
No, it's changing up.
Okay, thank you.
Any other questions? Can you put the motion on the board, Cody? Okay, so the motion that'll need is an approval of a recommendation. Oops.
Michael, would you mind?
Yeah, I'm
Wrong
sorry.
way.
I'm sorry.
Cody, I need the motion for the audit.
There
it
you
is.
go. No,
Okay.
it's.
So I need
that's
a
not it.
motion for approval recommendation to the full board.
That's not it.
Huh? Oh, then no, that's it. Where's the motion for the audit? Sorry.
It's at the front of the audit, Cody.
Oh, never mind. Sorry. That's where he was going.
There you go.
There we go. Okay, so now we'll need, with that complete, I'll need a motion for approval of a recommendation to the full board to accept the 21-22 comprehensive annual financial report and audit as presented.
So moved.
Second.
Any discussion? All in favor?
Aye.
Any opposed? I think that was everybody. All right, thank you. Michael, thank you.
Thank you. So if you have any questions later on, at some point, you're always welcome to get my contact information from Juan. And I believe what we've done in the past is present a draft as well to the full board. And once that's approved, then we find date, send it out.
Thank you.
Thank you.
Thank you for coming.
Thanks. Everyone have a good day.
Thank you, Mike.
Okay, I skipped over item number 4, not intentionally, but even though I haven't read, perused the minutes, if others have read them, ask for a motion to approve the minutes from the July meeting.
So move.
Second.
For a second,
Second.
any comments? Otherwise, motion, all in favor, say aye.
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 And no opposed, because that covers everybody, right? Okay, that is done. Okay, Cody, you can go to the number 6 item now. Okay, this is the matter of the disbursement policy and procedures RFQ that was sent out by Quan late July, I believe, early August. We received 4 responses. This was just give a brief background. This came about from the ACH fraud that occurred at the end, or occurred in January. It was discussed at the February committee meeting and in the subsequent March meeting. The discussion included having an independent expert come in and look at our procedures. And we deferred that matter until after the June meeting. So this is how we have these. We have 4 responses from 4 different parties. Some of these are CPA firms. One of them is not. CFO Systems is not a CPA firm. They are contract financial executives that work in all sorts of industries across the country. But Quan and I looked at these, and I'll just paraphrase. I think it doesn't take one. What you said is he's hesitant, and as well as I am, to pick someone based on a short submission and a price quote. This requires a little bit of some nuance and understanding, and our recommendation is that Quan and I go ahead and have calls with these 4 parties, kind of get a little bit further into the details with them, make sure they understand the scope of it, because as you can see, the price ranges are fairly wide, and then come back with a recommendation for who we would recommend to go forward with on the project. So the timing of this is that Quan would like to be done by the end of December. The new year begins, so we have time to do that this next month. What I do is suggest is that our motion request approval from the board with a finance committee chair and the CFO, that would be Quan and me, to, in consultation with finance committee members, make the selection, not the section, selection of the expert or firm to conduct the review. I think this needs to be more than, this is not like window shopping for something you just buy and pick it off. This needs to be a matching of expertise, someone that understands, understands what the organization structure, the organization size, obviously the statutes come into play, and further, what I would like is for Quan to have a resource on an ongoing basis. So I don't look at this as a one and done. I look at this as maybe, someone who can help craft things down the road so that he has a go-to for future. And whether that's a project base, whether that's on a retainer basis of some sort, or just an ongoing relationship. But this is not, in my view, this should not be a one and done. Just pick it based on price.
So is this, you're wanting, you guys are going to interview the people, but you're wanting to just go ahead and make a selection? Like, I think I would feel better if you guys went and did your interviews and did all that and then kind of reported back to everybody.
That would be my intent, is bring back to the next committee meeting through consultation. So we can change the motion if you want.
Yeah, I mean,
but I'd like I prefer not to have to go back to the board. I think the finance committee can make this decision.
Can we, or do we need to go to the board for approval of the expenditure?
It's already in the budget.
Yeah.
Well, the normal procedure would be to have the full board, the full committee recommend to the board that the contract be let. Is that not correct, Susan? Yeah, that's the normal procedure that we would use. And I agree with Michelle that I think the full board ought to have the opportunity to review this and ask questions.
I can't imagine that there would be problems with it by any means, but I just think if we switch it.
It just pushes it till October, and then that's all.
But I think we can get it done.
Okay, all right.
I think we can. I mean, this doesn't seem, you guys kind of talk to everybody and trust what you guys come up with. Can't imagine.
Okay, so does that mean I don't need to vote today, correct? We'll come back after we have these conversations and report back to the
Yeah.
committee.
Yes, I don't think it needs a vote if you guys just continue to
Okay,
vet, for the lack of a better word, the RFQs, and then bring your recommendation and why back to the next finance committee meeting. And then you guys can approve to take to the full board, whatever you and Quan recommend.
okay,
And I would hope that we would have a recommendation of the acting
Right.
CEO at that time also. Is that correct?
That's fine.
Yummy.
Oh,
Any-
still there?
Okay,
I'm here.
you don't have any
If we want to
comments,
get to
I'm
the
going,
next button.
you don't have any comments, I'm going to move on to the next item.
Thank you.
Number 6, okay. Number 7 is the matter pertaining to the, I guess, what I've labeled the Prop L facilities capital expenditures review. And this has been brought up so that in a similar fashion, we have we engage an independent expert to review the expenditures, the contracts. I don't believe anyone has reviewed this on behalf of the board. We at this point don't have an accounting or a complete accounting of what's been spent. We've incurred in excess of $100 million on capital projects. We have remaining obligations. Some of that was reported on June 20th. Some of the numbers, I will just say that the reporting is incomplete and some of the schedules historically were not accurate in terms of what the totals that presented were. And I think it's prudent that the board have someone look at this, look at these expenditures and how they were done to make sure they follow what I'll call industry standard, best practices in terms of billings, compliance with contracts. There's no unusual things occurring in terms of the billings that come through. I don't know that the payments have been an issue. I think they come through Quan's office or to the accounting department and they're paid. But I don't know the extent of the review that is done by accounting other than to just pay the amount that's been approved. So this would be, again, someone who is what I'll call an expert in this industry. So they would be a construction expert. It may be more than one party. It could possibly include an architect if that's deemed necessary. So this is a request to get an RFQ out the door. The number I put up there is 60,000, which I think is more than adequate for this. I believe something like this probably would be done in a couple phases. One would be once that party or parties are selected, is to have them do an initial evaluation of what the project's expenditures, and then come back with a recommendation for the next level of review. This is, you'll see an agreed upon procedures review. It's different than an audit. We don't, in an audit, similar to what Michael and Hunt Associates do, their objective is the financial statements taken as a whole, as well as the footnotes, which are obviously part of the financial statements. We're not, in this case, going to turn somebody loose and just say, tell us when you're done. You would have them, or in conjunction with the experts, write up specific procedures that they would do. They would perform those procedures and they would come back and report on those. And then depending on the outcome of that, you may decide to pursue some additional topics or some additional investigation. So this could be, if everything's they don't find anything, or this could be very short and sweet. Or if they do find some things, then we'll have that discussion and decide how to proceed. And what additional work might be done. So it's, like I said, it's not a quote unquote audit. So that's kind of the framework for this thing. I need a motion before
We need a motion?
well, do I need that before we have discussion about it, or?
Yeah, yes, need a motion in a second, and then we can have discussion. So, I guess I'll make the motion for that.
Is there a second? A second. Okay, discussion?
Okay, I have a feeling that that the full board has been well served by our staff in terms of monitoring these expenditures and making sure that they were appropriate, that they were properly handled, and that that's been done on a regular basis. So I can understand, the idea that, well, even so that's true, it might be helpful if we would just take a look at that, test and see whether that's true. But it's an expensive way to do it if we're confident that people are doing it. I mean, the $60,000, we could buy 100, what are the things called? Hotspots.
Yeah, but John, I mean, in the scheme of things, we spend a lot of money on a lot of other things. And we could have this argument back and forth for $120 million or $100 million. I think $60,000 is to show the people that voted that in good faith, you gave us this money. We have spent it. We had somebody else come in, audit everything. And yes, our employees did a fantastic job. And we already know what it's gonna, it's kind of like half the things that we do that we approve, that we have audits on, or that we have, what's the other word, consultants for. I mean, it proves a lot of times what we already know. I mean, I'm sure that when we audit Quan, I mean, I don't know. I guess I just feel like for that amount of money, I feel like it's the least that we can do to prove to the voters of all three counties that we have used their money appropriately. I don't know. That's just my view on it. I mean, you may disagree clearly, but I will say I've had discussions with, a couple of my commissioners, and when I broach the subject about this, they give me the look like, why wouldn't you do that? So I don't understand them not doing it, but that's just me.
Ron or Yummy?
Yeah, I just want to pick up what Michelle mentioned. We go through an audit of the financial statements. I have personally absolute total confidence in the finance and accounting function of the headquarters here. But we go through this exercise for confirmation. And at $100 million of taxpayers' money, I think this is an essential function to undertake. And also to the scope of this, the scope of a financial audit under generally accepted auditing standards is to determine material misstatements. And that is a broad term, which is far from a detailed analysis of every transaction that comes through involving a payment. And I think when we have something like this, we will have that greater scope of analysis on cash flow. So I'm in favor of this.
Yummy? Any comments?
Yeah, sorry, it takes me a while to get to the mute button. Yeah, I think it's a really good idea, and I agree with what Michelle and Ron are both saying. It's sort of the least we can do, and I think it'll be exciting to prove to the taxpayers that the funds were used appropriately. I think we will, I'm sure we will, like Ron was saying, we know what it's going to say, but we still need to do that. And for the amount of money, yeah, I think it's very reasonable.
Yeah, just picking up that again, I'm repeating what Gummy said in this case, but less than a decade ago, the library, a different composition of folks in it, but the library went to the taxpayers and said, please assess upon yourselves an additional tax. And I think that feedback is something that we owe to the taxpayers and the voters, because this whole thing had its genesis in the taxpayer saying, we will self-assess the tax upon ourselves for the library. And I think that's only an appropriate response now, again, almost a decade later, that they deserve. Now, it's the taxpayer that I want.
Question, what is the procedure for finding and employing the people that are going to do this review?
I don't think it's much different than what we do on any other RFQ. We would send it out to select parties that we believe have the expertise. That could be, I will use CFO Systems as an example. They have, I know the president of that company. They have experts in a number of industries. They have ex-CFOs from construction firms. Obviously, they don't have architects. That's why I mentioned, this may include engaging someone who is unrelated. Obviously, unrelated could be, from a different region, so there's no conflict of interest with the parties here. I mean, you only have two parties. You have Dunn and the architects that are key to this. But there are things that they would pick up in the contracts or the billings that I would never see. It's honestly, John, it's no different than if you asked me, because of the part of the work I do, I deal with medical invoicing, okay, and payments, and I can probably recite a lot of things about how the medical industry bills and how payments are processed and what should be paid that most people, I will tell you, 99.9% of people don't know, okay? So I'm not an expert in this business. We would bring somebody in who is an expert, who has probably been an ex-CFO. CFO Systems actually has somebody like this that has been a contract CFO. And so, like I say, that's where this would head. And I've been fairly vocal that, it puzzles me that this schedule, which has been on board docs for months and months and months, doesn't foot. Okay? It finally got fixed, I think, in July, but all the information that was below the total for the columns came off. Then, if you recall, on June 20th, around 8 o'clock in the evening before the June board meeting, we got this schedule, which, after looking at it, has some inaccuracies in it. And just as a matter of record, as far as the capital plan, there's some funds that are available that are not included in here. But, like I said, it puzzles me why we don't have a complete accounting of this thing at this point. So I have a construction manager, a CFO. I don't know whose job it's supposed to be. It just seems like that should have been standard practice at every building committee meeting. I should not be presenting to anyone schedules that do not foot. And so that's not the reason for this review. The reason is because we're going to spend close to $120 million when we're done. And the board has had no level of review of the details. And I'm not, it's not saying the staff has done anything. I just think it's a prudent thing to do.
So who
$20 million.
Who will issue the RFQ?
That will come out of Quan and Susan. Yeah, we're not going to change the process.
And then it will come back to the finance committee for discussion and review and so on.
Yes. Yeah, this is not a fire drill. But, you know, the sooner we get going, the better.
Okay, I understand.
Any further discussion?
Any further comments by the administration on this?
We'll have to figure out how to write it. We haven't done this one before, but we can do it.
Good.
We'll likely need help on the other end because there's only one construction manager. So we'll have to take staff from elsewhere to conduct the review, I'm sure.
Anything else? All right, so that I'll ask vote. All in favor, say aye. That's aye.
Aye.
I,
And that's everyone. So that's unanimous approval. Okay. All right, item number 8, there was nothing presented. I'll just report on this, and there's no, oh gosh, there's no step. I've been talking to Quan about the monthly financial reports. We intended to have something ready. It's not ready. So there will be some just minor revisions in terms of the presentation of the financials to give some additional information that wasn't previously provided, including, I'll just say things like month-to-date comparisons versus last year. Also want to expand the scope of the disbursements information that is included to the board. There will be some just reporting on staffing, sort of top-level summary headcount information and such. So it's a bit of a work in process, and but as it turns out, we don't have anything to present today. So there's nothing to vote on, and we'll bring that forward when he has available.
Could I comment on that? One thing I've noticed in the financials, to me anyway, it seems as though there's information that I find to be not relevant in terms of the big picture. For example, the fundraising, you know, that there's an elaboration of many donors that generously give, but it's just visually takes up a lot of space for a bottom number that is completely fades away in terms of the more relevant stuff on the first few pages we get. So you can do, I think you do more almost a compacting for reports. I would find that helpful.
Yeah.
Yeah, I would agree with that. I think that, you know, we could use a little different reporting on the fundraising side of things, because it appears sometimes that we're raising a certain number of funds and we're spending more money to raise it than we really are. And what we need is an overall report. What's missing is that we raised $4.5 million to do what we said we were going to do, which was to redo the mansion at Woodneath, and so that was you know, a good piece of fundraising. And so you have to look at the overall funds raised over a period of time against the cost of doing it, and it's worth doing that, but it should be done as a whole, not on a month-by-month basis.
No, I agree. So, and that's kind of the intent here, is to just get a fresh look at the financials and the way we report information to the board, and keep it top level, you know, keep it relevant, keep it top level, and understandable. And I think some of the pieces now, there's not always a lot of questions, because I don't know that they always understand what's you know, what the presentation means. So that's the intent. So we'll proceed on that basis. Okay, moving on to number 9. Okay, you have in front of you some pages that were printed. I want to talk first. It should be, Cody, is there a page that talks about the levy process? It was in,
process.
Cody, it's in the email and or if you can pull it up on board docs, it's in the email sent this morning.
Yeah, I think it was, it's in
It's
Word docs.
I can pull it up on board docs.
Yeah.
Yeah,
It's called Levy
it's
Process.
under number 9.1.
Thank
Okay,
you.
change my share.
While he's doing that, I want to give you a background because obviously the discussion here is intended to move away from what I'll call the automatic, the acceptance of the statutory maximum levy. And we'll get into the details, further details. But I first want to give you the framework for really the levy process and the timing. This may be old news to some of you. Some of you maybe not, and it's not a lot of detail, but as you're probably aware, in Missouri, the assessments are reset every 2 years on the odd numbered year, during the odd numbered year. And those assessment values are pegged as of the preceding December 31st. So the December 2022 values will be the reset for the 2023 year taxes and levies. So from a calendar year basis, that's all. If you look at what the counties do, that work is all done during the first part of the year. Then by the end of June, okay, the end of June, the counties have, and again, this is an assessment during an assessment period, or even during construction of new properties. They set the values, and those what are called pre-BOE, pre-Board of Equalization assessments are sent to Quan, or Quan receives those from each county. The counties obviously have Board of Equalization hearings, so there could be changes in assessed values that result from those hearings. Property owners could be paying in protest, other things that happen. By August 1st, those hearings are supposed to be completed. I don't know if that's always the case, but somewhere in early August, then Quan receives what is called the post Board of Equalization assessments, and those would be the final numbers. For the current year, he's received both Platte and Jackson County. We're still waiting on Clay County. I don't know what's going on there. So once that is in hand, there's the final levy calculation is done. That's a state form provided by the state tax office. That includes looking at revenue estimates. And obviously then we go through the process that comes to the finance committee, it goes to the board. Quan can have a certification, kind of an informal certification done by the tax auditor's office at his request, and then a final calculation is complete. That then goes, as I said, to the board. The notice to the county clerks then has to be date stamped in the mail no later than September 30th. So that is a drop dead date. And then after that, those county clerks will then submit the calculations to the state auditor. Obviously, that then goes into the system, and then you wait for the tax notices to go out the door. So that's the process. Any questions on that?
But just one, I'm trying to remember, it seems like Jackson County does something that's different than the other counties that require some change at the last minute that we had in the past. Can you explain that, Juan?
Yes, because Jackson County is a Class A county, and 2 years ago, Clay County also changed, followed with Jackson County. That's why for the past 2 years, we received a final assessment from Clay County and the last. Jackson County still give us the final assessment by the end of August. But Clay County, last year was September the 8th. This year could be around the 10th of September. But Clay County and always give to us by early August.
Okay, and so can we proceed on any of this without the Clay County certification being received?
The library board can choose to do that, yes. We will, if the final number is different, then we will make adjustment on the following year's calculation.
When would we make those adjustments?
You mean if the final assessment is different than the one we use on the calculation, then we will do the adjustment next year. When we do the next year's calculation, we have to use a different number.
All right. Okay, again, historically, or at least I want to say, I think Quan mentioned 15 years ago, you did a voluntary reduction.
Yes.
Okay. So let me just touch on that briefly. And I did an inquiry with the auditor's office. So if there is a voluntary reduction, okay, I'm going to use the 22 year, then the levy that is selected this year becomes the base level for the following year. Okay, so if we're at 34 cents, we go to 33, then 33 becomes the base level for next year. Okay, we are locked in for 2 years with that levy, and with the notation that it is subject to the same Hancock adjustments as any other year. So that means if the assessment values go up, there will be a Hancock adjustment to decrease the levy. If the assessment values go down, there would be an increase from Hancock in the levy. Okay, so we're not tied to the selected levy. We're still subject to the Hancock adjustments, but that's the starting point. In terms of the 2 year commitment, then what happens is any even numbered year thereafter, we can revert back to what I'll call either a different levy or go back to the what I'll call the statutory maximum, but no higher than the statutory maximum. So if we do this in 22, then we could do it. We could undo it in 24, but we don't have to. If we didn't do it in 24, then it would be 2026, 2028, and so on. Well, that's the statutory. The requirement. The requirement, if you do come off that, is to. I'm just going to read from the auditor's document. The Missouri statutes provide that a voluntary reduction taken in a non-reassessment year, parentheses, even numbered year, close parentheses, results in a reduced tax rate ceiling during the following reassessment year, which is an odd one. Okay. To increase the tax rate in the following even numbered year, the taxing authority must conduct a public hearing, adopt an ordinance, a resolution, or a policy statement justifying its action before setting and certifying its tax rate. So it's sort of the same process. That's you have a hearing, you say this is what we want to do with the levy, and proceed on that path. So we're locked in for 2 years, and it's like a voluntary reduction. Okay. So what transpired over the last couple of weeks, intensified, was some work by Quan, actually over the last month, I would say, was some work by Quan that culminated in the last few days with his vacation time. And I sent this out, and John, I apologize, I had the email that you that was in previous emails. So I understand you didn't receive it, but we have those. Cody, do you want to bring those up? There's a PDF called the Levy Tax Projection. It's should be 3 pages.
Yes, I've got it. Just a second. Can you see it now?
Yes.
This was sent out when?
These were not sent out. What was sent out was a form, was a version of this explaining kind of the methodology. So I'm going to walk through that here. Okay. So it was sent out on Tuesday late after, I think, Tuesday afternoon to Susan and Teresa. And I said I didn't know these. I was not aware that you changed emails. It's whatever email I had.
So is there going to be a request to vote on something here?
Yes.
And we just received the information and we're going to hear about it, and I didn't get it at all. My official.
It was in board docs on Tuesday afternoon, I believe, correct?
It's a big picture.
What was in board docs on?
There were 2 documents.
I'm in Board Docs now. I see all of this that's here.
It's actually under 10.1. I believe.
Under
There were 2 files. One is called projection version 906, which is September 6th, and then there's payroll comparison report that was also included as on that tab.
Okay, but there's been no indication that there was of exactly what we were going to be asked to vote on at this meeting. Is that right?
I don't believe that's yeah. John, the agenda had a voting item for the.
Yeah, but having a voting item and knowing what you're going to vote on are 2 different.
We're having that discussion right now.
Yeah, we're going to have that discussion right now, but this is not the way the committee is supposed to work. Gordon, you know, I've mentioned this several times in the past, that we need to get the information. If we're going to vote on something, we need to have the complete information, including the specific thing that we're going to vote on, needs to be out several days before the meeting. If you look at our expectations in our policies, that is one of the expectations, is that if the committees are going to function properly, they'll have the information that they're going to vote on previously to arriving at the meeting. And it's just not right to proceed with committees expecting them to vote, only hearing it at the time of the meeting. That just doesn't work.
Some of this information wasn't available until the last few days. Kwan was on vacation for a week.
We could have a discussion.
Would you like to postpone this discussion or reschedule and have another meeting?
Sure. I think that's important that we have the proper advance knowledge of what it is we're going to be asked.
You were copied on an email. I was not aware that you have a new email address. There was no correspondence from anyone.
Well, if you send things to the board through Teresa, she has my new email address and she knows about it. So therefore, it would have come to me at my new email address. Sorry, my email address changed. It wasn't my idea. It was Yahoo's idea that I should change my email address. So it was sort of a sudden thing, right, Brian?
My thought would be, instead of postponing a meeting or we're calling a second meeting, why not go through the material to have what is presented, and we can reflect on it. If the second meeting is necessary, at least we come with that background.
That's fine. I have no objection to that, but I do think we need to see it not only verbally, but then we need to see exactly what we're going to vote on when we're asked to vote on it.
I'm going to walk through that.
I know you're going to walk through it right now, but yeah, I think you're right, Ron.
Yeah,
I think we could listen to it now and then
Okay,
consider it at a separate.
all right, let's proceed because our clock's ticking, right? So you have 3 pages in front of you. If you look in the middle towards the upper, you're going to see one that says version 1, one says version 2, and one says version 3 that has a few more columns printed on it, but you'll see the version 3. So if you want to spread those out so you can see all 3 of them at the same time, I'll tell you the differences between those and what's happening, okay? So on the left in the yellow highlighted columns, you will see 2 that say the 2021 actual and the 21-22 actual. And then you'll see the 3 years, 22-23, and the projected for 24 and the 25 fiscal year. There's a total column for the 3-year total. In the right columns, which are shaded, highlighted in the green at the top, is a variation of the calculation. So that is what I am proposing we move towards. The current method, as is labeled in the yellow highlighted columns, applies the statutory maximum levy. Again, that is the historical method of doing things, okay? The above here, and I can show you in the Excel worksheet, but above here, Quan has put together the details of the valuation components being real estate, personal property, railroad, other things. He has looked at the historical data in terms of delinquent collections and so forth. And so we can send you the worksheet. You can evaluate this as you see fit. But this was put together by Quan. This is actual data that was used. And then we'll talk about what the projection numbers are for the columns that we're using here. The reason for doing a 3-year projection is to look at where we would end up if we select the levy, because we'll be number one locked in for 2 years, and the 3rd year, either it reverts to something else upon the election of the committee and the board, or you can elect to continue the voluntary number. So I'm not going to walk you through the details. What I will tell you is if you look down towards the bottom, which is this section right here of the worksheet, you will see some, whoops, I'm going to go right to here on the bottom of the page you have. You're going to see some assumptions. So in the 22-23 initial are the actual values for Platt and Jackson. We're waiting on Clay. Those aren't going to be materially different, we don't think. So for the bulk of the dollars are in here in terms of what will happen. The 23 and 24 assumptions that Quan put in are, you'll see that he was increasing Jackson County values. Again, this is the assessment that will be done dated December 31st, 2022. That will be the assessed values going out to taxpayers in 2023. So increased Jackson 5%, 10% was applied to both Clay and Platt. Personal property values across the board were increased by 10%. And you can see the new construction increases and the corresponding decreases in Clay and Platt. Okay. The next column over for the 25 fiscal year, you see that he applied a 2% increase in personal property values. No changes in the real estate, obviously that's the non-reassessment year, and he applied a 30% reduction in the new construction. Okay, collection rates are down below. We never collect 100% of the taxes. There's a 1.6%, at least in Platte County, there's a 1.6% reduction for the collector and the assessor. I don't know what the other 2 counties are. I assume they're similar. So that 1.6 plus delinquent taxes or taxes paid under protest gets you to a net collected ratio. And he used 94% for the current year, the current budget year, and 93% for the following years. Okay. So on your sheet, on that page 1, okay, number 1, I'm using the numbers he put together, which is the expenditures of budgeted expenditures 57 million. He has projected increases for the following 2 years for total expenses of 177,632,000. I'm not going to go into the final numbers. Okay, this is not to see that print. It's not on these that are on here. Okay, on your printed sheet, you're going to see above the 23 where I put in the current year budgeted revenue of 62,600,000. So the current valuations and the statutory maximum levy rate yield revenues in excess of budget of 2,654,000. Okay, follow that down. You'll see that on the line here. Blow this up. You'll see that yields excess revenues of $9.5 million against what I calculate as a required fund balance. So just following the numbers down, you
It says 9.6. but
Pardon
the
me?
Sheet says 9.5.
9.5.
Yeah.
Oh, okay.
Says 9.6.
We've had, well, I think did you print off the ones from this morning? I know what's on here is an earlier version, okay? That's the problem with what I have here is, well, you know what, let me do this.
It's fine, I'm just
No, it's
making
fine.
sure I was on the
I'm
right.
going to pull up the okay, you have 9.5, right? Okay, which is right here, 9.5, and over in that column, you have 16,806,000. Okay, so
Yeah.
same numbers. Okay, so we're going through a detailed calculation. Okay, when you do something like this, the best approach is to go through a very methodical process to look at your individual components, apply your individual rates for each county, make sure that things look reasonable historically on a forward basis, and then go through your mechanics for the profit and loss statement and any other adjustments. So again, in the aggregate, if we pick the statutory method and we apply the current debt service payments and using the current method for how things are done, okay, have historically been done, then over a 3-year period, we would be taking in $16.8 million over what the surplus required is, because the surplus requirement is now a maximum of 50% of, I believe, the next year's expenses. The calculation here I have is 60 or 50% of the current year, just because again, it's a maximum of 50%. So regardless how it's a benchmark, okay? So if our current year expenses for the 25 that's in here, in the projection here, are $61 million, then $30.5 million is what the board would require for fund balance. Applying the statutory maximum for 3 years, we would get to $47 million. Okay. Now, on the right side, there's a few more adjustments, just some minor things that I have over here. One is we've historically included in the operating budget investment income. So that means that income isn't that not only is the interest income included, but the market value adjustment on securities is included. Okay, those are more appropriately reported what I'll call below the line. I don't believe they should be part of the operating expense load. So I've taken that out. In this case, they're not significant dollars. It's $190,000 for the 3 years. You can see the amounts there. Okay. Some additional adjustments I made in our financial reporting. We report things at market value for investments. This 41,000 is the operating bond account, what I call the operating load. So the difference between what our market value is and our par value that we will ultimately collect at maturity was only 41,000. When you look at the capital fund, which has about 28 million in assets as of June 30th, that market value adjustment is $1.6 million. So I'm just going to say that that's a separate discussion for later, but the capital fund reporting should include what I'll call the ultimate collected dollars as well as the interest. Neither one of those are in the capital fund analysis in terms of what our available funds will be on a forward basis. Okay. The other two adjustments, the other adjustment I have there then is the actual investment income, which will we have $15 million in the current investment account. There is cash that's held that is sitting in a money market rates during the last year, 2022, were probably 1 basis point. They're pushing 190 basis points in most cases because treasury yields are now on a short-term basis at or above 3%. So I've just added in an adjustment factor. And again, this is for comparison. Again, that's not part of the expense load. That is, it's kind of like the savings account for the library. Okay. The last adjustment I made, you'll see, is what I'll call the capital maintenance reserve. That's something that I have asked Brent to put together. They've actually put together a policy. They wanted to report, but I've pushed that back because they really didn't have anything other than report other than they put a policy together. So this is a placeholder only. I don't know what the amount is, but if you look on a forward basis over a 10-year period, that would generate $15 million for maintenance funds. But again, that number is subject to what they come up with on the capital side. So that'll be something they're doing over the next several months. Okay. So following that math, then the other adjustment I use is I put in the debt payments. So one, I've just tweaked the surplus. In these 3 counties, we're in a growth phase, and with the level of expenses budgeted, I dropped that from 50% to 45%, and partly because we're going to load separately the debt payment as well. So I'm calculating as opposed to the current methodology, which would say we need 28.5 million. I'm calculating that we should have 32.2 million of available surplus. Okay, and then following along with the current statutory levy. The maximum levy, we would, in this method, generate 13.3 million of excess over 3 years. Okay. Again, that assumes, in both cases here, I've applied Quan's projections for those periods. All right. So if you'll flip to version 2, I think Quan circled your pages to show the bottom. By the way, I'll just show you up here if you want to see my screen that Quan has all the data loaded in terms of assessed values, collection, etc., as well as the budget numbers and projections. Okay, so in this method, what I did was I kept the expense load the same. I kept that at 50. Okay, but I moved in the debt payments. Okay, so now it's saying that I'm again applying the previous methodology, but I'm loading in the debt payments, and what I'm trying to do is get to something that is, where we're not taking in as much, that we don't need. okay? And I'll talk about the summary level later. So in this case, I dropped the levy by 2 cents to 3,268. Page 1, you had 3,468. I took it down to 3,268, again, both sides. So that produces a slightly lower revenue for the current fiscal year. We're budgeted 2.6. So in this case, I dropped expenses by 650,000 in each year. I still end up with almost 2.8 million of excess surplus at the end of the 3 years. Again, applying 50% plus the debt payments. And just for reference, those debt payments do decline over the period. I think they drop below 5 million either next year or a couple of years from now. So anyway, but those numbers will change. Okay, so that produces 2.7. Applying the same methodology over here, again, the investment income reduction, and taking the same expense reduction, the same adjustments I had before, then I get to a $5 million excess being collected over 3 years. So in both cases, I still have more than adequate surplus, more than covering the expenses and the maintenance reserves going forward. Okay, then I want you to flip to number 3. I think you have a handwritten page number 3 at the bottom. And there's version 3 at the top. Okay, so in this case, what I did was I left, by and large, the previous, get this lined up. Okay, so, so the difference here is down on under the green columns here, I changed the assumptions. Okay, I left what Quan had originally done here. I left those alone. I changed them to be less aggressive. So instead of in the levy calculation, what I call the Hancock adjustments, there is a provision that says you cannot increase any more than inflation or 5%. Well, inflation is more than 5% right now. It's probably going to be more than 5% next year. So we cap this at 5%. Right? We already know 5% comes into play in the current year. So that's the personal property values. One thing that's happening in personal property values is if you bought a used vehicle, maybe you bought a new vehicle, but you notice that the prices have escalated significantly. That bubble, as I'll call it, is starting to deflate. Wholesale prices this year, I think, were down over 10% in the last several months. I don't know where they're going to land. I don't know what the assessors do. The assessors get their values off of the state system. And then those numbers are applied to the tax calculation. Okay. So as an example, if, let's say, Ford Explorer that historically had a value of $20,000, it would not be unusual if you had to go buy that same car. If you bought that car 2 years ago for $20,000, you will get $25,000 today. Or you would have in the last year, you would have been able to get $25,000 for the car. So the question is whether the assessors are actually using what I'll call the bubble value, or they're using more of a trend value. I don't know the answer to that. I suspect it may be a mix of both. Over time, that will come down. The other thing that happens is people go buy new cars. New cars are worth more. That's higher value. So as they get rid of a car that's 10 years old, that has a value of 10 or 15,000, they go out and buy a car for 40 or 45,000. That new car comes on the tax rolls. So you're going to see increases just from people trading up over time. And so we've applied a 2% factor to those, and we applied that in both years. Okay. For the new construction, I left his current year down 20%, down 5 in claim plat. I don't know if those will materialize. I know interest rates are having a little bit of an impact. I'm also aware that there is what I'll call from the realtors, there's a housing shortage in the Northland. So I don't know if construction will slow down. But for this scenario here, I dropped it 20% for both years. And I dropped plat at 5%, which is the same rate. Okay. And then for new construction, I dropped that down from 30 to 40%. So again, it's a little more conservative approach. Left the collection rates the same. Those are historical numbers, and left the other factors the same. So applying, in this case, you get to where you pick a number. So in this case, I picked 3.22 or 0.3228 is the levy. And you can see over here, again, following the current methodology with the adjustment for the debt payments and simply reducing the revenue. In this case, over on project on the version 2, it was 650. Over here, it's 1.3. Then I'm still producing 3 million in excess of what my required surplus is. Again, I'm using 35.8 million for the requirement versus what the current policy would say we need to keep less than 29 million. Okay. Same thing over here, applying the same adjustments. And again, this methodology, I end up with $1.4 million. Again, the big difference here is just the difference in the assumptions on the growth impact for the 24 and the 25 year. Okay. So that says we're collecting, even with this minor adjustment and expenses, we're still collecting, we're still more than adequate on collections. And obviously that's including and taking into consideration what Quan has projected for expenses. Okay, so I know that's a lot of detail and it's a lot of weeds, and I don't want to get you into the weeds as much. So one of the things that happens when you think about this is you try and come up with a method with some form that is easy to explain. Cody, do you not have this PDF? I'll bet you don't. Oh, yes, you do. Never mind. You have it. Okay. So what I did is I put together just a summary analysis here that I think is fairly straightforward to understand what I call the bigger picture of things. So I have 3 columns. I have the current fiscal year. I have the 3 years that just ended, the 20, 21, and 22 years. And I have the projection there using the numbers that come off the other tab. So the way you would build a rate is you want to get to the load that's required against your assessment base. And so I'm going to walk you through this, right? So on the expenses, I have those are the 23, that is the budget expense. Quan made a couple tweaks in that, but they're not material. So 57.1 million is the expense load in the current budget. The 3 years historically, we spent 150.6 million, and the forward 3 years that he has is 177.6 million. So that's a $27 million increase on a forward basis versus what the last 3 years were. Okay, I put in a number, $2 million, because I know we had COVID, you had construction, so that's a number I just picked. Say, okay, I want to try and normalize what may have been done during those years. Okay. Then, as you saw on your version number 3, I dropped expenses by the 1.3 million here. So this 4.1 is the combination of that expense reduction and the investment income that's currently included in the expense load. Okay. Then I back off other revenues. I think I've doubled up on 65,000, but I'll deal with that. We'll deal with that separately. It's not material to the analysis here. Okay. Next line is capital plan funding. That is the amount that was transferred in those 3 years. That was not separately budgeted. That's what ended up just being transferred. So technically, that could have been, when you look at the load between those two, your expenses were 161.6. The money just wasn't spent, but I just classified it down here because that's what actually ended up happening. As it currently stands, we don't have any, there is no need for additional capital plan funding. There is adequate funding over there for the remainder of the projects that are on the table. Okay. The maintenance reserve funding, again, I mentioned that is a placeholder, and that will be a forward number. But again, until we get some real number, or if we get some estimates from the building committee during the course of this next year, we'll fill that in. But I think for the purposes of this is more than adequate, because right now it's zero. Okay, the last piece is the debt payments. So that's the debt payment going forward, 6.6 million. Those are the 3 debt payments we made last year, the 18.8 and the forward payments are 19.3 million. Okay, so that tells me that I need the next line is what I call required tax revenues. So that is how much I need to generate just from taxes to cover the remainder of my expenses and other obligations that I have above there. Okay. I am backing off the railroad and other taxes. Those are not done based on the assessments. Those are based on historical averages, as that also includes delinquent collections. As you can see, that runs about 8 million a year. That hasn't changed a whole lot. So that's the number we're using on a forward basis as well. Okay. That gets me to the net taxes collected that are required to collect through what I call the normal tax assessment. Okay, so that is a calculation all the way down. I'm using a 93% collection rate across the board, even though 94 was the rate over on the other tabs. The assessment base for the 3 historical years, that's the average 16.1 billion. The assessment base on the forward level or in the forward year is 18.5. Our assessment base for the current fiscal year is about 18.1 billion. Here I've only used the two years. I could pull in 23, but that number goes up, and I'm just trying to be a little more conservative here because it would produce a lower required rate when I get down to the bottom. Okay. And then the assessment base for 22, which as I mentioned, includes both Platt and Jackson at actual. We're missing Clay, but I don't expect that to be a material variance from that. So you can see that for the current fiscal year, based on that calculation, my rate needs to be 32.3219. If I look backwards 3 years, I am at 3448. Okay, and again, looking forward 3 years is a 3.3221, really kind of the same number as you're seeing for the current year. The difference in these is obviously the capital plan funding. With the capital plan being done, we don't need to be collecting those funds or continuing to collect those funds at this point. And again, until something is identified down the road, we'll address that at that time. So that's those are the 3 levels of the gory details. If I said in a preferred approach, you go through the detail analysis, and you make sure that your underlying assumptions are reasonable, consistent with the past, that your calculations are appropriate. You bring it up to here and say, okay, does this make sense? And the thing I would point out on a couple of these, in terms of the levy, while it looks like, again, our historical levy was not, I'm going to say it wasn't, I don't remember what it was previous to last year, if it was higher or not. I think it's dropped.
Yeah, dropped.
It's dropped. But this is comparable to what the current maximum levy is 3,468, and this is 3,448. So
Yeah, last year it dropped 13%.
Yeah.
Levy dropped 13%.
Yeah. Which was Hancock. So, and you also had a pretty nominal, I think your inflation effect was pretty nominal. So if any, but you're showing a pretty significant, even with this lower calculation, you know, that assumes 27 million more, actually not, that's not true. 173, so I'm going to call it just round numbers, 21 or 22 million more in expenses, you know, than what we've incurred for the last 3 years. What's different, as I understand, in the current year is we're opening Green Hills, Lease Summit opened on right at the tail end of June.
And North Oak should open in the spring.
North Oak will be open maybe a quarter of this calendar year. So, and Quan has those. Quan took that into account when he put in his numbers for the following years.
Right. Yes, yeah.
I'm not going to go through the details, but he took those things into account. So that is a top level summary of where we stand. It produces, again, this produces revenues going back to this calculation. You know, over 3 years, it produces in Quan's version at the lower rate 3228, it produces 192 million of revenues, 188 million over here. So about a $4 million spread on that. And we still end up with more than adequate surplus. I think it's prudent. This is something I looked at earlier this spring. I think it's prudent that we reserve for the debt service. Probably will get the, hopefully, I think it's just prudent to do that and as opposed to include it in the general reserve. So it's a higher number than what we've had in place historically. And the other piece is the investment income. While it's not, you know, in the scheme of things, it's not a huge number. I don't think we should be spending or saving or investment interest that is on our surplus. I think that should be a below the line on the P&L. And we have our tax revenues and our operating revenues, and that's what funds our expenses and let our surplus grow on its own. Okay, I know that's a lot. Are there any questions?
Well, one question is that I did not hear any discussion of economic development waivers, which we always deal with and which seem to be growing every year. That is taxes that are waived for economic development purposes. That's clearly been growing and will continue to grow. We'd like it not to grow. We are against it, generally speaking, although I think over the years we've admitted that some of the economic development waivers are so powerful in terms of driving the economy of the area that it's worth supporting those. But those are few and far between. There are many more that we have no control over, and they just tell us you're not going to collect those taxes anymore for the next 25 years because the waiver's been granted by this or that county commission or this or that state position. So, I mean, that's something that has to be considered. And again, that's the weeds, but you know, that's a big weed.
So how much has that been historically? Do we know the number?
I don't know.
There was a section in the footnote section of the annual financial report shows the amount of tax abated. I believe based on the numbers in 2021, that's about $4 million from all 3 counties.
4 million for that year.
Yes.
Right. So there's an accumulated, if you're accumulating this over a period of time, the accumulated waivers will add up to a significant amount of money.
But how does that come into play in your estimate of your collected taxes? Because ultimately, the only thing that matters is collected taxes.
Abatement is not in the budget. That we excluded that value from.
Exclude the value from.
Yes.
So the numbers you have in here are net of the abatement. of
Yes.
tax. So we've not estimated revenues, if I'm correct my words here, but we've not included revenues, and therefore we don't need to take any out.
That's correct.
That's correct. So we're net of all those abatements already.
Yes.
Okay. Good question.
Okay, another concern that I have, this is just generalized concern. I think there's a certain usefulness about this kind of review and looking at things this way. But I think you have to be very careful. When budgets are presented, and as a city manager, I presented 25 budgets over 25 years of being a city manager. And one of the things that you have to account for is what you don't know. And there always is a lot of what you don't know that goes on in budgeting. And therefore, good budgets have contingencies. And they're not always spoken contingencies, they're just contingencies of estimation. For example, you don't know exactly what your payrolls are going to be. You don't know when people are going to be hired that might be budgeted for. You don't know when people are going to leave and leave an open position so that you have more money than you thought you did. There's a lot that you do not know. And particularly, I'm concerned about the historic projections. Having a history of your finances over a period of time is useful in budgeting, but you can't rely on it completely, particularly during this past 2 years, relying on what happened from 2019 to 2022. I don't know many people that rely on historic projections in any business that happened during that period of time because of the pandemic. Everything changed. Everything changed. The whole IT issue changed. The salaries are changing. We see that the pandemic has produced an increase in salaries, a lowering of. We no longer have. We have 3.5 unemployment. That's almost historic lows. We have tremendous amount of change going on, and it's very hard to estimate based solely on historic data. So that's just I think the whole thing can be useful, but I think if we rely on that too much, we might find ourselves woefully short. I know just this year, we are in the health insurance thing. This was a warning that was given during the pandemic, and that is that people were not going to the doctor during the pandemic. And therefore, our health costs were extremely low during that period of time, and we developed quite a carryover amount during that period of time. And but it was clear that as the pandemic waned, people were going to start having to go to doctors and get expensive treatments that they had postponed because of the pandemic. And that's clearly happening all over the country. And it's happening here. And it's likely that we're going to have to put somewhere between $600,000 and $1 million in our account this year to account for the fact that we're going to have this rise in expenses this coming year. So I just use that as one not so small example of where we have to be careful about the use of historic data, particularly during the last 2 years. Look at the change in our employment situation.
Okay, John, we're getting off topic here. Okay, we can talk about this at length and take up the rest of the lunchtime. So I hear what you're saying. I pulled up on my worksheet here. I'm going to show you that historically, and again, the previous methods were to assess the statutory maximum levy and then build the rest of it into what I'll call the operating expenses. That has always produced an excess, okay? So if you look down here for these years, 17, this was the first year, that was the 16 is when the levy adjustment got increased. The next year was 12 million, okay? 5 million after debt service, 3.5 million, 6.5. So I hear what you're saying. I come back to here, okay, in terms of history, okay? So for 3 years, the 3-year average spending was about $51 million, okay? We didn't fire anybody, and not that I'm aware of. And if you look at the payroll data, and again, you didn't have this, but here's what's actually happened. I had Quan pull the payroll data for July 17, 19, and 22. These are the actual payrolls, okay? And you can see that and I put comparisons over here at the full-time, part-time, however those staff are coded. And I broke it down between headquarters and branch, okay? May not be a perfect breakdown, but anybody who's labeled under a branch is under branch, and anybody who's labeled with something other than branch is under headquarters, okay? So you'll see that what happened over 5 years is to what you're talking about, salary rates were increased. So at the headquarters level, over 5 years, our salary cost increased 30%, okay? The rate increased at headquarters 28%, you can see there, okay? The number of staff hasn't changed. We were at 170 5 years ago. We were 171 in July.
171, what, where?
171 headcounts. Those are bodies. Okay. Our full-time hasn't changed. Full-time was 164 in July 17th.
That's not
I
a-
bet to you on Tuesday.
Oh, okay.
Yeah, that came out in the email Tuesday. Okay. The branch counts actually declined. So we're at 800 in terms of head count in July. 5 years ago, we were 931. The big difference there is the part-time. So I hear what you're saying, but I come back to this top level thing, and that's the reason as you look at this, is to step back from all the weeds and the details. In this analysis is 27 million more in expenses. Actually, that's 153 versus 100. So 20 million more in expenses. Okay. So you want contingency? I think I have it. I think I have more than enough contingency in here. We're not building a new branch. We're not adding, 500 people. How are you going to spend $20 million? You might add $1 million in health insurance, but we're self-insured. Maybe our employees are healthy. Okay.
Well, then, we know that that's not going to be the case.
We don't know.
Yes, we do know. Yes, we do know, because we know exactly that the fact that during the pandemic, our costs went way down. So our balance went way up. And now that balance is going to be used up. And this year we're going to add significantly.
Yeah, but we're not gonna add
John, we're
millions,
not-
even if we
yeah,
had to,
John, John, I'm sorry, go ahead.
No, I think there's plenty in there to do that. I guess I'm sitting at the personnel side of me is just like, oh, I've been stressed out, but maybe we do have the money to do the things that I've been asking.
The numbers don't show that we had this radical change. We went from 3.6 million to 3.4 million. That's a $200,000 drop. And again, we don't have the employees. I don't know what their health condition is. And if it has to go up a few $100,000, it does. But again, back to here, there's 20 million more in expenses loaded into this thing than you've been spending. And what are you going to do with $20 million? How are you going to spend $20 million?
Perhaps pay off the debt earlier than we would. Perhaps there's an advantage in doing that.
Well, let me.
Perhaps there's an advantage in.
What about the people paying the taxes? Maybe they have debt they'd like to pay off. Maybe they'd like a little tax relief. We're taking money out of taxpayers. This is.
Well, it's interesting. I just did a quick
$16 million. You're suggesting we take $16 million out of the 3 counties because we think we're, we think we can make better use of it than they can. We have budget numbers that are more than covered, okay? We have our debt covered. And we'll have 30, we'll have 30, we'll end up with, if Quan's numbers are right, 38 million, on a lower level, 34 to 35 million dollars of surplus against a $60 million annual spend on expenses. I mean, at some, we don't need to collect for, the buildings.
Those are one person's projections.
So you want to,
I'd like for us to be able to look at the, all that basis and discuss it and agree
we are discussing
on some of these major.
We are discussing.
Yeah, but then I guess that brings it to, you're saying that's one person's projection, but that's one person that does an unbelievable job.
These are Quan's numbers.
These are Quan's numbers. This is somebody that every year his audit's winning, he's winning these awards. We brag about what a great job he does. I mean, this is unbelievable work. I don't know, in my opinion. I mean, but I'm just one of.
Why do we need to collect keep collecting $4 to $5 million a year for capital funds when we're done? We're done spending. We have enough money, and we're going to spend somewhere between 117 million and 120 million dollars. We've already spent over $100 million on it, and what's left is in the capital budget, and it's fully funded. Why do we need to keep spending? I'll give you a comparison. Platte County Commission just decided to reduce the roads tax, which for the last 20 years has been 3/8 cents. They decided to put on the ballot for November a 1/4 cent, which is a 1/3 reduction. The reason being that when the roads tax was put in 2003, all the bridges in Platte County were bad need of repair. Okay, they have will spend when they're done about $35 million. Okay. They made a decision, commission made a decision that they don't need to keep collecting money to replace bridges. Those bridges were somewhere in the range of anywhere from 60 to 100 years old. So now we have new bridges. So their decision was, we don't need to keep collecting that money. We'll keep supporting the cities and the things we've been doing. And so the ballot measure is to reduce the roads sales tax from 3/8 to a 1/4 cent. We're not in a too dissimilar situation here, where for the last 5 years, you've been funding a capital campaign. You did partially with, you put COPs out there for $80 million. And then you use the additional revenues that were generated both from construction, higher values, higher assessments by the county or by the county assessors, and you're collecting, you have enough funds. So why should we keep collecting money for things that we're not going to build at this point?
Well, the same reason that we want to have a maintenance reserve for our new buildings.
I have one. I've got it in here.
At what rate?
Well, I'd like to know what the rate is, John, because I don't have it. I've been asking for months. I've asked for a calculation of what we've really spent. I don't have that. It'd be nice to know that, but I'm going to go with the best information I have. Okay, and I don't have any information on the maintenance reserve. I said I just found on Tuesday, I found $1.6 million that they don't have in their fund because they're booking it at market. They're showing their analysis at market value. We're going to collect 1.6 million more plus 280,000 a year. So let's just call that 600,000 rounding. So I've got $2.2 million over the next 2 years that they don't have in their analysis. I have more than enough money.
But who doesn't have in there now?
The building committee and whoever prepared this schedule here that I received on June 20th, which is, as I've said, it's incomplete and inaccurate.
And Gordon has been asking.
I have been.
He has been asking for it.
I've been asking for this for months.
And, it's just like this. Goes to, I don't know who he's going to, but he's asking for it. And then I don't know if it's got to come from Jake. I don't know where it's going, but he's not getting it. he's got to ask Brent, and I don't, Brent's got to go to whoever. It's just not getting back. And I mean, that's, I think, a whole other issue, but so I don't know that he can accurately give that number.
Again,
I agree with you. It's time for us to move on to the next.
no, I have this up. We said we were going through this. It's up to the committee whether they want to make a decision. It's on the agenda as a vote. So I'm going to, is there any further discussion on this?
Can we really have without that number,
Without one,
without an accurate number for building? I know you have one, but no, from them not giving.
oh my God, I absolutely, Michelle. I come back to, I have $20 million built in. $20 million excess built in on expenses. That's more than enough to cover.
Okay, I'm just saying that they still haven't gotten it back to you, but without that, you're comfortable.
Well, if you want to wait for them, it's probably going to be next March or April. We don't have, we can't wait.
Is
You
there?
have to go based on the information you have.
No, that's fine.
And-
Susan, is there some reason, why the number's not getting done?
He was given, I asked for more information in an email to give him what he wants because he didn't want what was in board docs would have been presented before, and I have not gotten more detail.
Okay, well, I'm not talking about board. If he's asking for information to try to do this, but whatever's in board docs, it is what it is. Why can't? This is, I think, one of my biggest frustrations is why he seems to be getting information and working fine with Juan. Why can't Jake get that information to him? Like, why
I
are
compiled all of the invoices and everything for him. They're there.
Okay.
There's 80 pages.
80
worth of invoices.
detail that I'm supposed to summarize as opposed to your staff, as opposed to staff, summarize it in a format that I can understand.
You need to tell us what format you want it.
I
not
gave it
just in
to
Excel.
them in an Excel worksheet. I sent that in late May, early June. I gave a very detailed schedule of how it should be done, and I heard nothing back.
I don't have that information.
I
That was
forwarded
not given to
I
me.
forwarded you the email that I just sent. I sent you that in early August. So at this point, here, what number do you want in here, right? What number do you want me to put in right now for maintenance? Pick a number. Yes,
I don't know.
pick a number.
I'm not being difficult. You put in,
No, that's the
whatever you put in is
Well,
fine.
no,
I'm
but
just,
I'm
I guess my frustration lies more with, we're doing this, we could have this discussion all day long. But
You're right.
we're doing this, I don't want to, this is just more that I don't want to give him this number. I don't want to give him that number. I don't want to do this. I'm not going to do that because whatever reason, we're not doing it. And I don't know what form, instead of just picking up the freaking phone, asking what somebody wants, and just give the information. It's like, I'm beyond just as a board member, some of the stuff that he's asking me, he's a taxpayer too. I just, oh my God, this just frustrates me. Anyway, sorry, that's my own little rant. I'm just done. You're fine. I don't understand the roadblocks other than it just seems like we're doing it or we're not doing it because we just don't want to. And I, having been here as long as I've been here, truthfully expect more out of people. I expect my children to not do things they don't want to do because they don't want to do it. I don't expect professional people to do this. I just don't. So I'm fine with your number.
Just a question to confirm, the numbers that we have on the handouts and the screen, Quan, they came from you, you're the source of them.
Yes, I made a projection for tax revenue and also made a projection for the expenditures. The current year expenditure is based on the budget with a small change. For example, like professional fees.
Sure.
Yeah. The next 2 years, just my projection only.
Okay, and I think all of us have amazing confidence and respect for your abilities. Also, just to parallel what was mentioned before, I have been copied in on the majority of the email requests for data. And I've got separate requests for data myself, and not infrequently the response was something to the effect of, we've never done it before. I don't see why you need it, or in some cases, just something else ended in no response. Fortunately for me, the stuff I requested could have been picked up at another time. There was the urgency as is the statutory filing for this budget. So if we are now, as a finance committee and as a board, in the position where we are right now, it's unfortunate, but I think had there been more of a collegial, collaborative, open communication method, we wouldn't be here now.
So let me go back to the numbers, okay? I'm gonna use the numbers here, which is the best I have at this point. Included, this is the June 20 memo. You don't have this, I didn't hand it out. But included in here, this is based on the projection in the budget. Included in this analysis is $2 million of revenue over expense transfers that have never been presented to the board. So I took those out. The city of Riverside revenues are presented as $2 million, the actual number, because 650,000 is a land swap, is 1 million, should be 1,350,000. So I took out the 650. Okay. Then I added back the $1.6 million for the market value, or for the market value adjustment on the bonds that are held. And then I added in 280,000 because that is the actual cash interest we will receive on the bonds that are held. So that's let's call that 560,000. So I end up, fortunately, it was presented as 3.7 million. I'm $500,000 lower. So let's take my 3.2. I had in here 1.5. Okay, so I'm adding 2.5 million to 3.2 million. Round numbers. I'm in the range of 5.5 at the end of 3 years. And again, these are placeholders that can change. Okay. I'll end up with somewhere between 5.5 million and $6 million of a maintenance reserve. And supposedly we're done with construction. So why do I need, again, if I'm just doing maintenance, we will continue to build up the maintenance reserve. I would hope that we don't spend it on these brand new buildings that we just spent $117 million on. We don't need that money right away. So it's kind of like, when you look at how you do rates and savings for planning, hopefully they will come up with a number that says, if I have 34 buildings, I expect the roof to be replaced on this schedule. And it's going to cost X. And so my funding needs to match up against that. That's what I'm asking to be done. I'm hoping they can get that done. But if they don't, we're going to be guessing. We're going to be guessing next spring again. And I don't think that's the right way to do it. It's really unfortunate that we're in this position, but I said, I have to go with the best information I have. And I have zero information. So I made an estimate. I don't think it's an unreasonable estimate at all. I have $20 million of excess expenses built in versus what we've spent. I don't think this is unreasonable. So if you want me to add something, I just played with the number. If I made this 2.5 million over here, instead of 1.5, okay, then it changes that levy calculation over here to 3.324. We are currently at 3.486. So that's our discussion. I'm going to make a motion that we voluntarily reduce our levy to 0.34324 for the current budget year, and that we reduce the budgeted expenses by 1,310,000.
And do we have any response from library director about?
If you're gonna cut the budget $1.3 million this year, you guys as in the board have decisions to make on what we are not going to do.
Yeah, if we want to make a motion, I prefer the motion to state the number of cents to be voluntarily reduced instead of a rate.
Oh, okay.
Because
Okay.
that would easier for me to do the calculation.
So he could say 0.324.
You don't need to say that.
Or
Whatever the ceiling is,
2.6.
we
Okay,
voluntarily reduce
voluntary.
of cents.
I don't,
Well,
Well, all right, Susan, if I can respond to your comment there. We have budgeted over 3 years. Well, what's in the projection is a total of 36.3 million for library materials, okay? You spent over the last, and again, I'm using numbers, an average of call 11 million, okay? So this has historically been budgeted at 20% of revenues, okay? The staffing budget that I had somewhere here
it's about 60.
annualizes right now at $24 million. I pulled up, I don't have it because it's not on board docs, but when I looked at the annualized payroll against where we landed, Juan and I talked about this. If I use 2019, or the annualized payroll from 19 was 22 million, and the actual ended up at 22.5. So it was 98.6. The 17 payroll, which is a totally different time period, ended up at 103%. So I applied 24.5, or I applied 98% to get a higher number. That would say, using those same sort of analyses, I would end up in 24.5 million. The budget is 25.5 million for payroll. There are open positions. I know there's open positions that are out there that are budgeted. As my understanding, there have been open positions budgeted every year. I don't know the status of those.
If those vary.
Yeah.
Yeah,
And
just
you have
depends on how fast we
terminations.
can fill them.
So the other thing, there is, in this number here, the 1.8, there was 200,000 of what I'll call contingencies and a couple other items. Some of that is just maintenance expense, but between that, I think we talked about utilities are probably high, but I think finding $1.3 million between materials, payroll, and a couple line items in the expenses is pretty easy to do. Okay, and here's the thing. In my view, we will still have. Okay. Following that approach, we will still end up with somewhere in the range of, where's my number? With somewhere between 35 and 36 million of surplus on that basis. We still have more surplus than the current policy requires us to have. So if we end up having to make a budget adjustment somewhere in the third quarter or fourth quarter, I don't see that as a big deal. That's my personal view. I don't think we're going to be that fight. I don't think we're going to be in that position. And historically, we've never spent the budget.
we began this discussion with the idea that this was a fire hose of information that we were getting, a lot of which has not been presented until now. It wasn't presented in advance, and that we would take all this information, have a chance to digest it, ask additional questions, and actually act on a specific number at the next meeting. And I think that's a good idea for several reasons. One, because it is a fire hose of information, and we've not had a chance to see it. A committee can't act unless they have a chance to study in detail the information that is put before them, and we haven't had that chance. And the other reason is that we have a very important meeting starting at 1 o'clock. We're supposed to have some lunch between now and 1 o'clock before we try to make some very important decisions for the future of the library. And we need to move on. As a result of both of these things, I move that we table this until the next regular meeting of the Finance Committee.
So when would you like that meeting?
The next regular meeting of the Finance.
In October. In October.
What's
You want it in
the regular,
October?
what's the next regular meeting of the Finance Committee?
What are the statutory?
That's one of
The
the.
statute says we have to have this on file with the county clerk's date stamped on September 30th.
Yeah, we have to have a levy
You have to have it done.
voted on before the.
You have
end
to
of the
present
month
this to the board.
By statute.
So here's my question, John. We can study this. You can study this. Will you come to a different conclusion? In my view, I won't tell you how much time I've spent. Okay, I know you don't care.
No, that's not true.
Well, that's true, John, because everything you do is an attack on what I present. Okay.
Okay, hey, hello. this
No,
is-
let me finish. Okay, so I've spent hours and hours on this. Quan has spent hours and hours on this. He and I have been on the phone for probably 6 hours going through this detail. Will it materially change? I don't think so. I've done this 100 years. I've been doing this for over 20 years. Okay, if he has a mistake in his calculations, I should have caught them and vice versa. Okay, so will it materially change? I don't think so. Will you come to a different conclusion? I don't think so, because the top level summary over here is intended to say, how far do we think we're off? We have built into the rate $20 million more than what we spent for the last 3 years. And we're opening 2 branches, 3 maybe. And I'm sitting here somewhat in amazement that we can't make a decision when historically, given the way information was presented to the board, we were presented a budget without historical context. I was given budget information without any historical numbers. I don't know how you make a budget recommendation, which is what it ended up happening. Okay. And so I have no trouble with this recommendation. I think it's like.
But then we would have a discussion. We're going to have a whole nother discussion on this at the board meeting, right?
Yeah, the board can choose to do something different.
Right, I think, Gordon, you did make a proposal, and I don't, no one had a chance to second it. I think a lot of us feel comfortable enough to make a decision today, especially because we have to make a decision. So I think maybe you could present your proposal again, and we could see if it's seconded and it passes.
Two motions on the floor.
Yeah, he's made 2 motions.
There's
So we've got 2.
Okay.
Has a motion first, and then.
Okay.
Then.
a motion to table.
To clarify, we're gonna,
Motion to table.
it's just a motion to take Gordon's that was first was a motion to approve it, but then to take it to the board.
Yes.
But that wasn't seconded, and I made a motion to table, and a motion to table takes precedent.
Was it seconded by anyone?
No. Your motion combined number 9 and number 10 together.
I know.
So, okay.
Okay, so
So what happens?
I need to hear.
But we need clarity on it. We can.
We have to have some clarity on the motion to
We have a
table.
motion to table. But here's the rules. We have to have this done. If you want to take it to the board, it has to be done no later than next week. So if you want to have a second meeting, we need to schedule a second meeting. The numbers aren't going to change between them. I'm done doing work in this. Quan is done doing work on it. The only thing that may come in is the Clay County actual numbers. If that happens, we'll make that change, and it'll flow through, and we'll see what the numbers are.
Is the director today ready to recommend that we act on this?
This is a board decision. I mean, we do have to have some levy certified before the end of the month, whatever that is. And then whatever you guys decide on, we'll deal with the ramifications and figure out how to make it work. We've submitted a budget that we knew that we were going to use for the year, and obviously there's disagreement on whether or not that those numbers are needed or not.
Question is the motion to table. I make a motion to table.
This is Yummy. I just got, somehow when I started talking, it, I guess, threw me offline, and now I'm back online. So I have no idea what just transpired the last few minutes.
Okay, so just, I had made a motion that combined 10 and 11. John made a motion to table. So the question is whether the motion to table is going to be seconded. I guess those are those the rules of order?
Yeah, second.
So that overrides my motion. Is that correct?
No, let me say something. And first of all, Gordon, you made the motion several minutes before John made in his motion, and it was just walked over. And no, I wanted to second it, and I didn't get the opportunity to. And then John made his to shut it down. So I think we need to go back and follow the order. And Gordon's proposal was presented first. So I think we need to see what happens with that.
Attorney Morrison.
Yeah, let me perhaps clarify something. So procedurally, you've got a motion, you had a motion on the floor by the committee chair.
Yes.
That motion had not yet been seconded. Later on in the discussion, Commissioner Laney had a motion to table. That motion had not been seconded. So I think where you're at is you still have, you have two motions, neither of which received a second. Had there been a second to the first motion, a motion to table would, if it's seconded, would supersede that, right? And you would take a vote on the motion to table. If it's tabled, then you move forward. If it's not tabled, then you revert back to the pending motion, which is your motion. So I think maybe where you're at on all of this then is you don't have a motion. You have a motion, but you don't have a second.
So you're saying, so I should ask for a second on John's motion?
Well, we need to go in order. We still need a second on Gordon's motion, and Yummy.
Okay, so I
Go through that process.
so can I clarify the motion and just stick to number 9?
And can you?
Is that okay?
Yeah, can
What is it that we're voting?
you
for?
also
Voting on.
send me that or email me
I
that
don't know.
motion so we can see it on?
Well,
the
it's up
screen?
there. It's, the motion is on board docs.
Well, no,
Which
what?
one? 9 or 9?
So are we combining 9 and 10?
No, we'll do them separately.
Okay, my stuff keeps going. Where?
So we're gonna go back to number 9. We didn't have a motion for that.
It was
Not a
sent out.
motion because you can't put X's in a motion. You have to fill in the blanks, so it's not on there.
All right.
So you have to
all right,
put it in.
so, okay.
We
all
didn't
right.
have the number.
Okay.
Correct.
All
You
right,
did not have
okay.
numbers, so I couldn't.
Okay, so the motion is to approve the operating levy at 0.3240 for fiscal year 22-23, a decrease of 0.0228.
Is that the whole motion?
That's the motion.
That's the motion.
Can you get me to bring that?
I want to have it up on the board, John, so you can, so everyone can see it and the. How can we project this on the screen? Brian?
Can you type it in?
Is there a way we can project this on the screen?
No, I mean, we just have to,
Okay.
we have to have Cody
Um,
type it into something.
Cody, can I send this to you and then you project this from the email or something?
Yes, I can
Okay.
do that.
Second, please.
Pass this one.
Sorry.
So I'll need this one too, I guess.
Oh, okay. So
Okay, Cody, I just emailed that to you.
Okay.
if we get past that one, then that would be the next, I guess.
There's a meeting up.
I was on it, so I didn't go under it.
No, this is what
We
we
don't-
were
we're gonna go through the rest of the stuff really fast. This is one.
Let me zoom in.
Zoom it in. There you go. Thank you. It's approval to recommend to the board, to the full board.
Yeah, and then if there's issues that we need to come
Well, no, it'll
forward,
come
then
back.
yeah,
It'll
that
come
would
back, but
come
you're
back.
okay, if we just go. So you don't need, I don't need to bring it up here. Okay, that's fine. I'll take it. Because I want to get done.
Yeah, so they were picking up. Realized unrecognized gain. For investments.
We should be taking into consideration the everyone's lost. Yeah. Because we're going to get that money.
It's a lower cost.
Yeah. Yeah, and it's not, it's only 41,000. Building funds, 1.6 million. Yeah, it's a lot of money. But that's
Is that the bank balance here?
that's what the gas need. Those are gas we pump season should be following.
No,
We can do
nothing,
internally what we
nothing.
can do internally what we want to do.
Nothing over the cash.
Right, correct. I can't read that.
Do we reread it?
No.
Okay. All right.
I have to put my other glasses on. So it says 32.4, a reduction 0.0228. correct?
224. Correct.
Okay.
228. Yes,
That's the motion.
yes. Here, he made it a little bit bigger.
Okay,
too,
so can
hopefully
we
that helps.
proceed or not?
But we need to finish the motion.
You have it up there. 2.28 cents.
Okay, put cents.
Another dollar sign, 0.028, 2.28 cents.
It says it's
Just take the dollar, take the dollar sign
Take
off.
the dollar sign off, Cody. And right, Juan, would you like the word written cents and you want the word cents?
It doesn't, it just needs to, it can be the 4 decimal places.
Okay. There you go. You're good.
And this is for number 9, correct?
Correct.
Okay.
So are we ready?
Yes.
So the motion has been made and seconded, correct?
Correct.
If there's no further discussion, I'll ask for.
Just one point. I have absolute faith in numbers that Quan could come up with, and I agree with the methodology. One remaining shoe to drop. Is it legal? Is there anything we're doing here outside the statute of any sort that might apply?
Anything you're doing here on the motion,
At the meeting, yeah. Okay, because
I would say no.
okay, yeah,
I mean, I think what you're doing here is what you're charged with doing, right? You're charged with making a recommendation to the full board. This motion, then if it's adopted, will go forward to the full board as a recommendation. The full board then will be required to discuss this, and the full board will need to act on a certification of a levy on or before September 30. Failure to do that has consequences. The full board can modify and as I think Cheryl already mentioned, can change whatever this recommendation is.
Of course, that's correct. Okay, good. Okay. So the motion is, to just repeat, approval is recommended to the board, the operating levy for 22-23 to be 32.3240, a decrease of 0.0228. All in favor, say aye.
Aye.
And opposed?
No.
Okay, no abstains, so the vote is 4-1. Okay, the second amendment then deals with the budget. And Teresa, oh, you have it up there now. So
Just a second, board, I'm sorry. Bill, do we still need to recognize John's motion?
no.
No, okay. Okay, thank you, sorry.
All right,
Cody,
I'm going to proceed to item number 10, which is the budget amendment. The motion is to make a motion to recommend to the full board a reduction of the current revenue budget from 62.6 million to 61,200,000 and I guess you have 90,000. Those numbers don't add up, but
You had
is it 13?
Yes.
Yeah, 290. Yeah, that's right. 61,290. All right, it's okay. It's okay. 61,290 decrease of 1.310 million, and we'll apply that to the expenditures. That's the motion.
Well, I just want to make sure it's clear. When you say current estimate, well, do you want to reduce?
That's the budgeted revenue.
Okay, do you want to reduce the expenditure or reduce the revenue?
Both. We have to reduce both. It says a corresponding reduction of an equal amount to the total expenditures, so we have a balanced budget. If I reduce the revenues, I'm asking to reduce the expenses by the same amount, so we end up balanced.
Because you're not. Yeah, okay.
I still want 0 at the end of the period. Is there a second on that?
Second.
Yeah, we can do it. It's fine.
Okay, any further discussion? Hearing none, all in favor say aye.
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 Aye. Opposed?
No.
Okay, so again, the vote is 4-1. Okay, we'll prepare that for the board. Okay, I'm going to get through these other items very quickly. The standing finance committee meeting schedule has historically been the first Tuesday. Pardon? First Thursday, sorry. And I'm going to suggest we don't have to vote on it and we need to get done here. I'm probably going to push that to the second Thursday, which is obviously closer to the board meeting. But I'd like to have time for the financial to be prepared and to be available for the meeting. So that's where I am. We can talk about that at the next meeting in further detail. If we want to change that to a different day of the week, or you have some thoughts, you can send them to me.
Would you still want the 10 o'clock slot?
Pardon?
Would you still want the 10 o'clock
Yes.
slot? Okay.
Unless there's some objection to that, we'll take the same time slot. Okay.
Just FYI, in October, I'm out of the country the second week of October, so.
I'm out of town that week, but
We'll get everything done.
Just kidding.
Okay.
This is Yummy. Can I ask a question?
Sure.
I'm just wondering if we could change the location. Do we have to meet at the headquarters? I'm just looking at who is on this committee, and I believe most of us are actually in the Northland. And I just wondered if we could do that. I mean, it's for me to drive.
Yeah, maybe we've talked about it. Let's. I want to get this done so we can get on. But yes, we'll we'll move the meeting for the headquarters. Okay. Teresa, there were no public comments?
No.
Okay. The other business dealt with central bank and investments, and I'm just going to give you a quick 10-second. Quan and I are going to, would like to meet with with central bank just to get an understanding. We haven't met with them I think several, some time to get clarification on the investment policy and what they're doing. And we'll report back at the next finance committee meeting. That's it. So no other business. I've asked for motion to adjourn. Second. Second. All in favor, say aye.
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 Opposed? And the motion is closed or